Hello, everybody. It is Whitney Emanuel with Strategic Visionaries. I hope you are doing well on this beautiful day. I wanted to come to you today with Money Smarts, speaking about behavioral finance and what behavioral issues affect financial decisions. Lots of them, and you would be surprised, but really it has a lot to do with our biases. And how do biases influence our buying decisions and our investing decisions? And just like anything else, the psychology of a person's mind and how they process things really affects everything that they do. And money decisions are no exception to that rule. And this is why, a part of my practice, it is so important to align your values with your money decisions. You don't want a mismatch there, because then you'll be unfulfilled and money will be a topic of anxiety to you, and you won't have peace in that if you are not in alignment with your values and what's important to you. So let's talk about a couple of the decisions that all financial planners encounter, but I also encounter in my practice with clients and potential clients. So one of these could be anchoring. So that's a behavior where you attach your thoughts to a reference point, even though there may not be a logical relevance that's pertinent, right? So an example of anchoring could be, Whitney, I'd like to buy stocks because, I really think that US companies are the most stable and they won't lose money because they've been around since the Great Depression. And so you're not really thinking about your investment goal. So that's not really relevant to what's important to you and your values, or what's important to you and your timeline. You just want to buy stocks. I get a lot of times people come to me, but they don't really have a goal for their money, or they don't have a timeline. And I can't create any type of recommendation or really invest your money or do an insurance policy for you if you aren't giving me the goal. So it's completely irrelevant. You're anchoring it to something else that is completely irrelevant to your financial planning picture. So that is an example. So it's my job to circle back and say, hey, what does this mean for you? Money is not important. Investing is not important if it's not accomplishing your goal. So really circling back, what's your goal? And that's a way to counteract that type of thought process. Another one that I find quite interesting is cognitive dissonance. This is not just specific to investing and financial planning, but it's the tendency to misinterpret information that is contrary to an existing opinion, or you only pay attention to the information that supports your existing opinion. So this is human nature written all over it, right? We only support what already agrees with our current perspective. So let's say you have invested in mutual funds in your 401k, and you believe that mutual funds are the best because your 401k has done great for the last 20 years. And let's say I, as your financial planner, provide you information on exchange traded funds. They're lower cost and they're more efficient in the market, meaning they don't have a drawdown of cost that mutual funds do. And so sometimes they may outperform, sometimes not. But at the end of the day, they have less costs associated with them. And let's say I provide you the data of an ETF that has the same type of investments that a mutual fund has, but because of how it's managed, it's outperformed. But you are so tied to that mutual fund because they've done so well for you that you are not willing to change. That is a definition of cognitive dissonance. It's really in a desire not to change, which a lot of people don't like change. They don't want to challenge. They're already proven bias that has supported them, and so they have cognitive dissonance when they receive information that is very clearly telling them to change their behavior, but they're still not willing to. So that's an example of cognitive dissonance. Number 3, and this will be the last one, and this is very, very common, it's overconfidence. So the overconfidence bias is concerning an investor that listens mostly to himself or herself. And they are overconfident investor, and they think that they're relying on their skills in order to get a superior rate of return. And so they feel a sense of control over an outcome that they really have no control over of. over. So let's just talk about somebody who lucked out. Let's say they inherited. Let's say this person inherited Apple stock, okay? And let's say when they inherited Apple stock, they believe that they're continuing to sit with Apple stock as the stock has split over the years. That is because of their own decision to stick with Apple stock. What really, it's just they decided not to make any changes and they just went with what they had. However, they're tying their wealth now that they have tied to Apple stock to their own investing decisions. And so now they're going to use the same investing decision to try and pick and choose stocks that they believe they're going to have a favorable outcome with, even though they have no control over the outcome of these stocks. We are only part owners when we purchase stocks. We're not a part of the management, so we cannot control the outcome of these stocks. The one thing that we can control in our portfolios is diversifying and not being overweighted in any one single company or sector. However, overconfidence would cause a person to be only in one type of stock or only one type of sector, something that they're familiar with, or something that has done well for them and they don't want to, again, change. So that's overconfidence. I encounter overconfidence some of the time, but really it's people believing that they can control the outcome of the market. We really can't do that. What we can control is how diversified you are in a portfolio. So those are three examples. I mean, there are dozens, but those are three examples where your behavioral biases, when you come to a financial planner, could be challenged. And so it's important to come with a learning attitude, because when you talk to a financial planner, that's somebody that literally studies this day in and day out. And if they have your best interest in mind, they're going to make recommendations that are best for you, that are proven, that are data driven, and that are factual. So, but again, I try to bring it back to not just the facts, but really what's important to you, what are your values, and then how can we support your money, how can we make your money decisions support your end goal, support your values so that you have more peace, money does not bring you anxiety, and you're not overconfident or underconfident, depending upon your circumstances. So again, that's Whitney Emanuel speaking about behavioral finance and behavioral biases when you come to financial planning. Thanks so much and have a beautiful day.